Okay, fun seekers. Oh boy, do we have a presentation for you because we are going to slug through a typical tax return 1040 form for the average homeowner. And it's a little tedious, folks. So, what we really hope you'll do is print out the tax exercise forms, the Form 1040, the Schedule 1, the Schedule A. Print those. Don't print out the tax tables. They're 20 some pages long, but we'll refer to that. And we're going to refer to them in our presentation, but they're going to show up tiny, especially if you're looking at this on your cell phone. So it really makes sense to have those printed out. The tax exercise number 1, Form 1040, the tax exercise number 1, Schedule 1, and the tax exercise number 1, Schedule A. Okay, so get ready, get your thinking caps on, and get a little calculator out, and let's get started on slide number 11. With the Republican tax cut of 2017, the IRS decided it was a great opportunity to overhaul the method of reporting our taxes. See, they used to have 3 forms. They used to have the 1040, the 1040A, and the 1040EZ. So they said, okay, everyone's going to use the 1040. Well, I'm really sad about that. I wish they would have just gotten rid of the 1040A because the 1040A was not very useful. But the 1040EZ was very useful for a large percentage of the population that had no deductions, had no adjustments to income, no capital gains and rent and all that stuff. They just had their income, their paycheck. And so it was easy. Well, they got rid of it. So now the 1040 has been simplified. I never trust the IRS or accountants when they say that things have been simplified. It used to be 2 pages. It is still 2 pages, but now has additional 3 schedules. And it depends your situation, which schedules you're going to use. How could anyone possibly state with a straight face that adding an additional 3 pages is simpler? Adding to that the confusion of which 3 pages to use. I'm still fairly confused about a few things, but I got the general picture. But take heart, dear students, in 2019 it was an additional 6 pages. So they at least have simplified from 6 down to 3, but still they went from 2 to 5. Anyway, let's get started looking at page number 1. At the top of the 1040 form, it's relatively straightforward. You put in your name, social security number, your address, any dependents, occupation and the like, and the filing status. That's the tricky part. We talked about that. It's not that tricky. We talked about that in the previous presentation. Are you single or married filing separately? Are you married filing jointly? Are you a head of household, a single parent, or are you widowed? Now, the social security number of dependents must be included. There's an exception if the child was just born at the end of the year. Yeah, well, you have to send it in eventually, but hey, we don't have it yet. In 1987, the IRS started requiring taxpayers to include the social security number of dependents. 7 million children and other dependents mysteriously disappeared. Do you think Americans would cheat on their tax returns? Now, don't forget to sign your return. Look, if you forget, relax. Contact the IRS as soon as possible. Don't send in another return with a signature. What they'll do is they'll send you out a form that says, okay, I filed my taxes, but I forgot the signature. And you just sign that and send that in, and that's good for your signature. So don't forget, first of all, and it's very easy to do. You did all this work, and all of a sudden you put it in the mail and or do it but if you do it electronically, you don't have to worry. Electronically, that's how you sign your return by clicking here. So the middle of page 1 is where we're going to start throwing in numbers, and most of these folks are just not going to be applicable to many people. The biggest one is line number 1. What did we make from our employment? Wages, salaries, and tips. Some people will have some interest. Well, the banks are starting to pay a little bit more of interest, but still not much. Dividends, if you have in stocks or mutual funds or other types of securities, as they're called. Hate that term. And then, did you take any money out of your IRA, or did you have a pension, Social Security? Wait a minute. Are Social Security benefits taxable? They may be, they may not be, depending on your situation. Any capital gains or losses, any other income from Schedule 1, and then line 9 is your total income. Then we're going to take away any what are called adjustments from Schedule 1, and we wind up with the adjusted, that's a mistake, I got to fix that, adjusted gross income. It's not adjustment gross income, it's adjusted gross income. So let's take a look. I'm going to run on over to the 1040 here. Here it is. You see it there, you see it. And here is the top of the page. We put in the person's name or the couple's name. In this case, it's just one individual. A King Back. A King Back. You know A King Back, don't you? Yeah, of course. And then he puts in his Social Security number, and then he has he puts his identifying information, and he's the head of household because he has a child who he has, he's in charge of the child. The parent, the other parent, can't also take head of household. One parent must do that. If two parents do it, as we said in the previous presentation, eventually they're going to come back at you and say, you can't do this. And then he has a child, Wayne DeBack. Wayne DeBack. Yeah, Wayne DeBack. And he put his Social Security number down, and he's their son, and he's his son, and then he qualifies for the child tax credit, which we'll see later on. Also, notice that they've snuck in this little question right here. Did you receive, sell, exchange, or otherwise dispose of any financial interest in any kleptocurrency? You see, people think, oh, I did Bitcoin or whatever, and I don't have to pay taxes on it. Wrong. The IRS is saying, yes, you do. And so they want to know right up front. And if you say yes, then you've got some work to do. And you probably should get a program or go see a professional, because you probably, maybe unless you did one or two transactions, if you did several transactions, you're going to have a whole list of transactions that you have to report to the IRS. And then if you want to, you can send $3 to the presidential election campaign. That's up to you. Most people don't do it. And the the candidates now don't usually take the money, because if they do, that means they have to abide by other restrictions about how much money they can raise. So I don't know what's happening to that money. It must be piling up somewhere. Now, folks, the people at the IRS are people, sort of, kind of. And, they have feelings. And so what people would do is they would write in the margins, you suck, IRS is unconstitutional, don't pay your taxes, or other kinds of things. Or maybe they would just leave their Social Security number off or not sign the return. And so the IRS went to the Congress and said, we're tired of this. One gentleman turned in his 1040 EZ form, this was many years ago, on the back of a t-shirt. I don't know how he figured that one out. He must have somehow, really, really savvy with t-shirts, and took a picture of the 1040 EZ form and superimposed it on a t-shirt and then wrote on the t-shirt. I don't know about the specifics, but the IRS was sick of this. So they have talked to the Congress. They talked to the Congress and said, look, we want to be able to fine people. We want to be able to penalize people for filing what is called a frivolous or nuisance return. So folks, don't write in the margins that the IRS sucks. Make sure you sign your return. Don't leave the Social Security numbers out. The taxes are the price we pay to live in a civilized society. So now, here is the wages. So for 2021, A. King reports $61,900 for his income. So that goes on his W-2 form, right? The W-2 form, and it is reported here. And then he had $100 worth of taxable interest. If he had tax exempt interest, they still want to see it, but it does not get taxed if it's tax exempt, right? Then all these other things we talked about that most people are just not going to have: qualified dividends if you own stock, or ordinary dividends, IRS distributions, I'm sorry, IRA, individual retirement account distributions, and how much of it is taxable. Same thing as pension, how much of that is taxable. And you think, what? Well, sometimes when you pull money out of an IRA or a pension, some of it is tax exempt. Sometimes it's a lot, sometimes it's not much at all. So you are going to have to know that, and the form is going to tell you. And so some of you are already given up and said, I don't want to do this. Look, just forget it. Just forget it, because most people are not going to be affected by these. Social Security benefits, capital gains, these are the two we're only going to worry about. These are the two forms of income we're only going to worry about. So lines 1 and line 2B. Then you, if you have any other income, that comes from that one form we just talked about, Schedule 1. We talked about one of the schedules 1, 2, and 3 that they've added. So any other income would come from that schedule. We're going to look at Schedule 1, but we're only going to do adjustments, not additional incomes. So our total income is $62,000. So $61,900 plus 100 is $62,000. Now, the IRS will audit individuals who, for some reason or other, they think need to be audited. And often, the IRS says, often it's just because they did the wrong arithmetic operation. Instead of adding, they subtracted, or vice versa. So do read it carefully. Or better yet, take the VITA course and learn how to use the software, and the software will read it. We'll do it. We'll do the calculation for you. But so we added up the two incomes, and those are the only two incomes we're going to work with in this class. And we got $62,000. Now, what are these adjustments to income? These are a way to reduce our income. And so we have to go to that Schedule 1. See, these used to be on the 1040 form, but they moved them to Schedule 1. So let's move on over to Schedule 1. And notice that the first page of Schedule 1 is additional income. And again, most people are just, look, gambling income. Any debt that was canceled. Yeah, if you had a loan and they canceled that debt, the IRS says, hey, that's income. I don't think that's very fair at all. But that's the way the Internal Revenue Code is set up. And then look, most jury duty pay, any prizes or awards from a lottery or whatever. So look, it's empty. Page 1 of Schedule 1, all the additional income that somebody might get, alimony received, all this other business income if you have a business, if you have rental, real estate, farm income, unemployment compensation. Maybe people will have unemployment compensation. That goes on Schedule 1, and you would total all that up and put it back on the Form 1040. But we're going to take a look at the second page, because the second page has adjustments to income. And these are items that allow us to reduce our income, which means we reduce our taxes. Now notice, if you're an educator, if you're K through 12, I'm pretty sure, or I would have taken advantage of it. It's K through 12. And if it turns out that the schools don't give the teachers enough money to fix up their classrooms for supplies and the like, so that it comes out of the teachers' pockets. And so the Congress goes, okay, well, let's give them a tax deduction for that. And I think it's limited still to $250. And some of the teachers are saying, are you kidding? $250? I spent a whole lot more on my students than that. So there's some teachers who are screaming it should be higher. But all we're going to add to our adjustments to income is an IRA deduction, because AKing makes a monthly or yearly contribution to his individual retirement account. And he also has some student loan interest that he pays. So we made nice round numbers, $1,000 of IRA deduction and $1,000 of student loan interest. Now you notice that as I mouse over this, it's allowing me to actually go in there and put the data in. These forms are PDF forms that allow you to type in data, and then you can save it. It's kind of cool. And then add up all the adjustments, and at the bottom we have $2,000. So he's reduced his income, adjusted his income, reduced by $2,000. And notice it says, okay, now go put this on 1040, and that's exactly what we did, line number 10. And so here it is. He was able to reduce the $62,000 by $2,000, and his adjusted gross income is $60,000. So I know it seems, oh, I can't stand this. It's not that difficult. Once you go through it and do the ones that pertain to you and ignore all the rest, it's actually not that difficult. So here we are at adjusted gross income, and I will fix that by the time you see this. The adjusted gross income is an important number. Many tax items are tied to adjusted gross income, such as the ability to contribute to your retirement accounts or utilize certain deductions and personal exemptions. So that is an important number. So that's line number 11, and we saw that his was $60,000. Now, we talked about this already. Schedule 1. Additional income, taxable, refunds, alimony received, business, farm. You total all those up and then put them on 1040 form. And then the adjustments to income, educator expenses, health savings account deductions, retirement deductions, alimony paid, student loan interest deductions. And we did the retirement contribution, which allows us to reduce our taxes, retirement deduction, and then a student loan interest deduction. And all these items used to be on the previous 1040 form, which, I don't know why they moved them all here. Actually, they expanded them. So I understand. They said, oh, we need another page. So that's what Schedule 1 is all about. And we've gone through that already. And take a look at it. I suggest you print it out to get a good look, unless you have a really big screen, then you can have it on one side and have the presentation on the other side, because we're going to continue, dear students. Slide number 15. I'm sorry. This is where it gets a little tricky. Slide number 15, my apologies. Line number 12 allows us to further reduce our income via one of two ways, but not both. This is where people get confused. You can take the standard deduction, which is in 2021 was $12,550. For the 2022 ones, I think have come out yet. I'm not sure. They go up every year according to inflation. And if you were married, $25,100. Notice it's twice as much. And then there's one for a head of household and married filing separately, and the widower gets to use the married. Or the standard deduction, everyone gets to use that. Or you can itemize your deductions. Medical expenses, state and local taxes, interest paid, gifts to charity, casualty, theft losses. The problem is, if the total of your itemized deductions is not greater than the standard deduction, it is more beneficial to you to take the standard deduction. And of course, you'll pay fewer dollars in taxes. So people get upset when they go to their tax preparer and they say, look, I gave some money to Father Joe's Village, or I gave my car, donated my car to KPBS or Southwestern Community College Foundation, which are all verified charities. And your tax preparer says, well, do you have any other deductions? And you say, no, that's it. And they say, well, it makes more sense for you to do the standard deduction because this car was worth whatever, $1,000. If you're single and it's not more than $12,550, or married $25,100, it makes sense for you to do standard deduction. And so then people go back they go back to Father Joe's village and say, you told me I was going to be able to use this as a deduction to reduce my taxes. And they say, look, we told you may be able to do that. We told you to consult your tax preparer, your tax professional too. So remember this, folks. It says important concepts. You get to take the standard deduction or the itemized deductions, but you can't take both. So let's run on over to the 1040 form. Where did it go? It disappeared. Oh, there it is. Okay. Here's the 1040 form. We're on line number 12. And it says, look, standard deduction or itemized deduction from Schedule A. Now, what we see over here are the numbers we just gave you. And you probably can't see them if you're looking at this on your phone, but it's $12,500 if you're single or married filing separately, $25,100 if you're married filing jointly, which is the best way to file if you're married, unless there are knives and court orders involved. And then head of household, $18,800. So now, notice A. King put in $22,000. See, if he was just doing the standard deduction, he would have put in $18,800. But he says, no, I have more deductions than that. So he has to then fill out Schedule A, the homeowner's friend. And what the IRS has done, not the IRS, the Congress, they said, you know what? Fewer people are taking advantage of itemized deductions now because we've raised the standard deduction quite high. And so the charities jump up and down and scream, wait a minute, people used to be able to deduct. And so now there is a method, depending on your situation, where you can deduct some of your charitable contributions. So that donation to Father Joe's village may be able to be deducted even if you take the standard deduction. You notice I say may, because it depends on your situation, which is all the more reason to learn how to do it using the volunteer income tax assistance program, get college credit, and to become a tax preparer. See, this is when we say it's relatively easy until it ain't, until these things that are really, really tricky that the Congress, see, we're going to, at the very last slide, we're going to say the reason it's so tricky is the Congress, they don't have to do their own taxes. No, it's done. They're done. Their taxes are done for them. So what do they care? They don't care how darn complicated it's gotten. But anyway, so A. King is taking the itemized deductions. So now what he has to do is he has to go to Schedule A. So let us take a look at Schedule A. There's Schedule. No, that's not Schedule A. There's Schedule A. And notice Schedule A is itemized deductions. He puts his name and social security number. And now you'll notice that there are categories: medical, dental expenses, taxes you paid, interest you paid, and then gifts to charity, casualty, theft losses, and other itemized deductions such as job-related expenses and then tax preparation costs go here. Now notice that A. King left the medical and dental expenses blank. Now that doesn't make any sense. He's got a kid. Of course, you would think that Wayne DeBack would go to the emergency room at least once or twice a year with, gashes and broken arms and the like. No, not every child does that. But still, why did he leave it blank? Well, what you'll notice is that once you put in your medical and dental expenses, you then have to put down the adjusted gross income. Remember that from line number 11? And you multiply the adjusted gross income by 7.5%. So the first 7.5% of your adjusted gross income, you cannot deduct as medical expenses. So I didn't calculate it. I should have. Let me get my calculator out. So he has $60,000 of adjusted gross income times 0.075. He has to have at least $4,500 of medical expenses before he can deduct his them on his taxes. The first $4,500 doesn't get isn't eligible. So he says, "No, I don't have that much. You don't really want to take advantage of that. It means somebody's sick in the household." So he leaves it blank. But he does pay taxes. He pays state and local taxes. That's his income tax and the like. He pays real estate taxes. He has a condo. He has a car. That's the state and local personal property taxes, the DMV vehicle license fee on your, you'll see it on your registration. It says VLF, vehicle license fee. And he adds all those up. And notice, we'll see this when we get back to the presentation, that the limit is $10,000. That was part of the 2017 Republican Tax Act. They limited the state and local taxes to $10,000. Why did they do that? They wanted to get back at the Democratic states like California and New York. It's really cruel, but they got away with it. You know, they may be evil, but they're not stupid. They know how to get vengeance on people who don't vote Republican. So, so his total state and local taxes and the real estate taxes, personal property taxes, $5,100. Now, wait a minute. We said that his standard deduction was $18,900, right? So he's nowhere near that yet. What's going to bump him over the standard deduction? The mortgage interest deduction. The mortgage interest deduction. He has a condo, and he paid over $16,000 in mortgage interest last year. And so you see, that's going to push him over the $18,900. So there are a few other items you can itemize here: mortgage insurance premiums, points that you paid to the lender when you got your mortgage, and you're going to get a document that tells you, oh yeah, you can put this on your taxes. And so $16,200 of mortgage interest. He made some gifts to Father Joe, $700. And then he didn't have any casualty or loss, and he didn't have any others. He could put down his how much money he paid to have his taxes done if he did that, and any job-related expenses. But let's make it easy and just put all these four here. These three, I'm sorry. $5,100 of state and local taxes, $16,200 of mortgage interest, and $700 of gifts to charity, and that's $22,000. Now, does A King have to send in all the receipts for this? No, he just has to show them on the Schedule A. But if the IRS sends him a friendly little letter that says official business only, you said that you paid $200 in personal property taxes to the state of California, specifically for your DMV, please send us a copy of that. That's called a correspondence audit, and that's the easiest one. And it's not that big a deal. Keep your records intact, right? That's why I say keep them forever. But people tell me I'm overly paranoid. But yes, that's what you have to do. Hang on to your receipts. You don't need to send them in, but you do need to keep them in case they say, yeah, well, we can't find this because a lot of times this information is sent to them. The mortgage interest is sent to them by the mortgage company. They send it to you and they send it to the IRS. So the IRS goes, oh, okay, cool. Yeah, he did pay the $16,200. So that total there of your itemized deductions goes back on Form 1040. Let's get to Form 1040. Whoa, what happened? Oh, that's I'm going to get rid of Schedule 1. Get out of here, Schedule 1. There it is. No, what happened to the Form 1040? I think I accidentally deleted it. Oops. Is it gone? Window. Yes, it is gone. Let me go back and get it. My apologies, dear students. I accidentally deleted it. You're seeing my computer screen. And there it is, back again. All right, my apologies. And then it's got to get this mess out of here. Get this mess out of here. My apologies there. So notice there's the 22,000 we were talking about. Let's make this a little bit bigger, zoom in a little bit bigger so you can see it a little bit better. So there's the $22,000 that we just discussed on Schedule A. So you might have a business, most people won't, and then there's another deduction for that. Qualified business income deduction it's called. And then $22,000 is our total for the itemized deductions. Remember, you can take the standard deduction or the itemized deductions, but you can't take both. So finally, at the bottom of page number 1, we have our taxable income. So now let's go back to the presentation and just literally go over what we went over from the standpoint of the presentation. You get to take the standard deduction or the itemized deductions, but you can't take both. So now, so where do they go? As we said, they go on Schedule A. Medical, dental expenses, the first 7.5% of your adjusted gross income doesn't count. State and local taxes, another attack by the Republicans on the blue states, limited to $10,000. Oh boy, did that get people in the I hate the term blue states, red states. I just hate it because it continues to divide us. You know, are you blue or red or purple or whatever? So, but it's attack. It was definitely attack on the high income, high tax states. And then the interest, another attack. They on mortgages going forward. Not if you had a previous mortgage, no, but on mortgages going forward, the mortgage interest is now capped on the first $750,000 starting in 2018. So again, people who live in states where the housing is very expensive, like California and Chicago, near Chicago, New York, and Boston, Philadelphia, Washington. What they don't realize is that housing is getting expensive all over the country, so it's going to come back to bite them. I think. I don't know. We'll see. Gives to charity and total deductions. And many other deductions were literally just gotten rid of. They just got rid of them in 2017. Now, the qualified business income deduction is very cool for people who have a small business. However, as Forbes magazine points out, it is rife with limitations, exceptions to limitations, phase-ins, phase-outs, and critical but poorly defined terms of art. If you have a small business, you definitely need to look into this. I've used TurboTax, and it seems to do a very good job with it as far as our little situation, my wife and my situation concerned. But definitely you want to look into this if you have a small business. So then on line number 14, we add up the total deductions from Schedule A and then the qualified business income deduction. And we get our taxable income. Congratulations! We have finally determined how much of our income is taxable income. We can now compute our tax due on line 16 of page 2. However, there are a few methods and we need to determine which method to use. So let's go back to the 1040 form and go to the next page. Oh, that's the Schedule A. I'm going to get rid of the Schedule A. We don't need it anymore. Let's go to the 1040 form and go to the next page. And so notice on line number 16, it says, okay, tax. See the instructions because there is more than one way to compute the tax. We are going to use the very simple way, and that is to use the tax tables. But again, depending on your situation, and if you fall into one of these situations, you're going to know that you either need to use one of the tax preparation software programs or go talk to a professional. But most people are not going to be affected by this, folks. And most people are not going to be affected by this. So notice we have typed in $4,279. So where does that come from? Where does it come from? It comes from the tax tables. And don't print this out because it's quite many pages, and you only need one page for most people. And notice it's for 1040, and what's the SR? That's for seniors. That's for old folks like us. But it's the same. It's the same table. I don't know why they say that, but what we do now is we have to go down and find the taxable income. So notice it's just a bunch of numbers, folks. And again, if you're looking at this on your phone, it doesn't look like much. But if you remember, it was 38,000. If you remember, let's go back and say back to the taxable income, 38,000 for a king back. So let's go to the tax table, and we finally found 38,000. And we want single, married filing jointly, married filing separately, or head of household. Oops, we want head of household. That's the last column. So we go to 38,000 and 4279. I did it correctly. Thank you very much. Now you might say, well, it says 38,000 up here. Can I go 4273? No, it doesn't work that way. As soon as you hit 30, if it was $37,999.99, yeah, we could have used this column. But as soon as we hit 38,000, we've got to go to the next row. But here, it's $4,279. And again, people just go, oh, this is so difficult. I can't understand it. But it's not that hard, folks. If you sit down and go through the table and find your taxable income, and it's really just a table lookup. But because there are some people are just so adverse to numbers. And if you are, I'm not trying to blame you or shame you or anything like that. Just, realize that you'll do it. You'll be able to do it. You'll work through it, and you'll be a better person for it. Anyway, so that yeah, right. So we put that down, the $4,279. Okay, now if we have any additional taxes, they're going to be on Schedule 2, but we're not going to bother with that schedule. Let's go back to the presentation. So here we are, dear students. What is our tax due? Well, the taxable income from line 15 on page number 1 is used to compute the tax due. We are one of the many people who have taxable income up to $100,000, and so we use the tax table. But there are a few other methods, and again, if you're making over $100,000, congratulations, of taxable income, that's after your deductions, congratulations, and go buy TurboTax or one of the other tax programs, or find a tax preparer, or take the VITA and learn how to do it yourself. There's another method called the alternative minimum tax, which we'll discuss in just a bit. Our system is called a progressive tax system. It means the more money, it's set up such that the more money you make, the higher your taxes are, versus the average tax rate that some advocates of a flat tax have been advocating for many years. We're not done yet, though. There are more issues that we will visit after we discuss the marginal tax rates. So we've used the tax table to figure out what our taxes do, but that doesn't mean that's what we're going to pay. There are more issues that we will deal with. But first, let's discuss the marginal tax rates. Here they are for 2021. This is your taxable income. This is after you've deducted any of the standard deductions or the itemized deductions or the adjustments to income or the qualified business income if you have a business. And so the first $9,950 of your taxable income if you're single is at 10%. Notice it's doubled for people who are married. The first $19,900 is taxed at 10%. As soon as you go over that first tier, that first bracket as they're called, now your tax rate goes up to 12%. That's single from $9,950 to $40,525. $19,900 to $81,000 if you're married. Notice they're doubled. And then 22%, then 24%, and 32%, 35%, until finally, after you're making $500,000 or $600,000, then you're paying 37% of your income to the federal government. but only on the amount over that. They don't go back and recalculate it. The first tier you charge at 10%. The second tier you charge at 12%. The 2017 tax cuts gave the average poor family a tax cut of $60. The middle class saw an average tax cut of $930. Folks in the 95th to 99th income tax brackets got about $13,480 back, and the top 0.1% saw an average tax cut of almost $200,000. Wow. However, once the plan is fully phased in, taxes go up for the bottom 40%, will be unchanged for the middle 40%, go down slightly for the 80 to 99%, and fall sharply for the top 1%. Surprise, it pays to be rich and contribute to Republican candidates because they take care of their own. Notice in 2020 that the rates stayed the same. The rates don't change, but the brackets changed. Let's go back and take a look at that 2021 again. For a single person, it's $9,950 in 2021. In 2020, it was $9,875. So what's going on here? The rates don't change. What happens is with inflation, the brackets are just raised. And that way, with inflation, we don't get an automatic tax increase just because we're earning more because of inflation. So that's how that works. From 2011 till 2012, the tax rates were temporary and adjusted every couple of years. After the fiscal cliff fight at the end of 2012, the rates became permanent. There's no such thing as permanent tax changes until the 2017 tax cuts. The rates again are temporary until 2025. But the Republicans vowed to make them permanent by 2025, but that's not going to happen. So you see what's happening, folks? As you make more money, your rate goes up, and as inflation happens every year, the brackets go up. So the rates stay the same. As you make more money, you get charged at a higher rate, but that rate doesn't change. What changes is the bracket. And if I've thoroughly confused you, stop, rewind a few minutes, and do it again. Now, here are the 2019 brackets. Notice, 97,000. The percentage rates do not change normally unless the Congress futzes with them. The tax brackets are simply adjusted upward according to the inflation rate. The 2019 brackets were lower than the 2020, 2021 lower than 2022. Remember that, again, they're temporary until 2025, but who knows what's going to happen by then. So you see what's happening? Let's, again, key on the single individual. We go to 2021, 9,950. 2020, 9,875. 2019, 9,700. So we see them going up with inflation. So now let's take a look at the 2022 marginal tax rates. Notice that the single has gone up to 10,275. And so it's going up with inflation, but the rates stay the same. So now let's say a person has $42,775 of taxable income. So that is after we've taken all the deductions and the adjustments and that. So the first $10,275 is taxed at 10%. So that's $1,027.50. The next amount from $10,275 to $41,775, that's taxed at 12%. So we subtract the two. We don't do the whole thing at 12%, the whole amount from zero. That part has already been taxed. We only taxed from $10,275 to $41,775. So that's taxed at 12%. So that's $3,780. And then anything above $41,775, and notice I chose $42,775, so it comes out to $1,000. It makes a nice round number. Is charged at 22%. So that's $220. So this person making in 2022 $42,775 of taxable income will pay approximately $5,027.50. If they had gone over $89,075, they would be taxed at 24%. They go over $170,000, 30. You get it? You see what's going on? The next dollar you make is always taxed at your current marginal rate. And that's an important concept that people just have a hard time figuring out. They want to know the average rate, but that's not important. I mean, it's something we can calculate, and we will, but we want to know what our next dollar is being charged at. And that's why the marginal tax rate drives people nuts, but it's an important concept, and we wish you'd learn it now because we're going to use it for the rest of the semester. Okay, here's the average tax rate that we discussed. The single taxpayer from the previous slide had $42,775 of taxable income and $5,027.50 of taxes due. So their average rate, we take the taxes due divided by the taxable income, we get a little under 12%. You see what's going on? Who would win and who would lose with a flat tax? If we had a flat tax, we'd have to charge around 20% to everybody. And so people who are making a whole lot of money, their taxes would come down. People not making a whole lot of money, their taxes would go up. Then the flat tax advocates say, well, wait a minute. Let's shelter the first $30,000 for single and $50,000 for married people. Okay, well, then you're getting back to the idea of a progressive tax system. So let's talk about it, okay? Let's at least discuss these issues. And then there's a whole other group of people who say we shouldn't tax income at all. We should tax consumption. You might have heard of Herman Cain. He ran for president a few times. He passed away from COVID, sadly. But he was pushing this. He was saying we shouldn't be taxing income. We should be taxing consumption. And it makes sense. You want people to earn as much money as they can. And then when they spend it, that's when you want to hit them. Well, we have a sales tax that goes to the state. So this would be a national sales tax, which other countries have. And so what scares me about that is because what scares me about the idea of a national sales tax, a consumption tax, a fair tax, they call it, is that the Congress probably will add the fair tax, the sales tax, and keep the income tax. So that's what scares me because, making sausages and making laws, they're basically the same. You don't really want to know how they're done. And so that's what scares me about the consumption tax. Okay, the marriage penalty. If the marginal rates are higher for single taxpayers, how come we sometimes hear people complain about the so-called marriage penalty? Because the second wage earner in the family pays their taxes at the highest marginal rate. They don't get to take advantage of the lower tax brackets. Actually, married couples with only one wage earner get rewarded, not punished. But of course, they need more money. There are two people. In 2017, Congress removed the marriage penalty for all the brackets except the very last one. Notice that all these brackets are twice the amount of the single. All the married are twice the amount of the single until you get to the last one. 520,000, 620,000. They created a new marriage penalty, though. Both single and married filers have the same $10,000 state and local tax limitations. Yeah, another Republican attack on the democratically leaning, I hate the term blue states. Pretty bad, huh? What do we say? Now, so that's the marriage penalty. It's gone until 2025 when it comes back for some people. Now, the alternative minimum tax is something that most all of us are not going to be affected by. However, it was originally meant to make sure everyone who could afford to pay taxes would pay some taxes. Why? Because in the 1950s and 1960s, the incidence of tax loopholes and it just exploded. So these multimillionaires were not paying a dime worth of taxes. Well, when that went out into the popular press, it was not very well received by the general public. So the Congress in 1969 created the alternative minimum tax. But in the 1960s, the late 1960s, early to 1970s, $100,000 was a very unusual and substantial income. But that's not true anymore. If you have two wage earners, both working really hard, you could easily wind up with $100,000 worth of income. It's affecting more and more middle class individuals as wages climb with inflation. Again, especially in the high income, high tax states. And each year, the Congress passes the exemption. It was eliminated for businesses in 2017, but not for individuals. So if you're starting to float up to those areas, you may be hit with the AMT. Again, if you are in that situation, go out and buy a tax preparation software or find a good tax preparer, or take the tax class at Southwestern, become proficient. I'm sounding like a broken record. My apologies. All right, now we'll scan through the various. Are you still with us? I know it's pretty tedious. We may have some alternative minimum tax or Affordable Care Act payments from Schedule 2. Most people won't have that. We now will look at lines 19 and 20 where we have tax credits. And it was up to $2,000 before COVID hit, and now it was enhanced to $3,000 and $3,600 for children 5 and under. So I'm not sure how long that lasts, as I remember, but that was COVID related. And then there's foreign tax credits, child independent tax care credits, education credits, retirement savings credits, energy credits. Again, most people are not going to be affected by this. But let's run over and take a look at it in the tax exercise. So here, notice that he has his income is $4,279. And he has some extra. If you have anything from Schedule 2, some additional taxes, we don't normally have those. Here are some more credits here that we're not going to worry about because there are very few individuals who are hit with that. But notice that he is not affected by most of these credits. So we put in the taxable. The taxes that were taken out of his paycheck here on line 25A. This is the amount that was withheld from his taxes, and we put that there. Now, what the IRS is doing is they're putting the amount that you pay here, and then this whole area is where you might have some additional. This is the money you paid through your paycheck. But then here, notice, there it is. A Kingback's child is under 5, so he gets that refundable checks credit. That means if he had less than $3,600 in taxes, they would still give him the money. They would still give him more all that tax credit, as opposed to a non-refundable, which means if you don't have more than that tax credit, then we're not going to give you more. We're not going to, if you wipe out your taxes with this non-refundable tax credit, we're not going to then give you more money. But with the earned income credit and the refundable child tax credit, and then also American Opportunity Credit and these other credits, tax credits, which are very cool. And if you're eligible for them, you want to know that. That's why you should take the VITA or go to the VITA people or use one of the software programs. So notice we add up all this all this data. That's the $800 that he paid, and then the $3,600 he got from having a child under the age of 5, and that's $4,400. His tax was only $4,279, and so he only owes the IRS $121. So again, it's tedious, slog through it, and you should be able to figure out what we're doing with a king here. So let's go back to the presentation. Notice here it is. Total tax was on line 24, and we only had to deal with the taxes that he got from the tax table. But if you were eligible for foreign tax credits, child independent care credits, they would go here. So now, slide 24. Hooray, total tax. We now know how much we owe. Well, maybe not, because he's going to get that child tax credit. Now, tax credits are very cool, dear students. A tax credit reduces our taxes dollar for dollar. Whereas the tax deduction from Schedule A, that just reduces our taxes by your marginal tax bracket. So if we're in the 22% tax bracket, then we would see a $100 tax deduction reduce our taxes by $29. But if we get a $100 tax credit, we reduce our taxes by $100. So sound like a test question? Right. Tax credit is an amount subtracted directly from the amount of taxes due. Tax credits are worth more than tax deductions. So now, here's the W-2 form, the little snitch that tells the IRS how much money we made, how much was withheld in federal taxes, Social Security, and Medicare payments. And so this is the form that everybody who has an employee, who is an employee, gets. Now, you may work for a company that treats you like a business, independent contractor, then you get a 1099, and that's a whole other world. We're not going to deal with that, but it's not something that's typical. But people who work for Uber and Lyft and some of the folks who work for Amazon, they don't want to have employees. They want to have independent contractors. And the government is kind of angry, especially California. We think they should be employees. Now, depending on your situation, you might think it's a good idea, a bad idea, but that's the debate that's going on now. So now, line 25. Final. Well, we already showed you that. That's the withholding, the pay-as-you-go system. So let's go back to the form. Just take a look at it again. Again, here's the taxes that we owe. But line 25 is the amount that we've paid through our W-2. And in A. Kingback's situation, he's paid $800. Now, the IRS says, look, you can't wait until the end of the year and then pay all your taxes. You can't do that. You have to pay as you go. If you do that, they'll hit you with an underpayment penalty. So you don't want to do that. Many people get a big tax refund. Now, it's not the best situation because you're giving the feds a free loan. But with interest rates so low, it's really not a big deal. Unless you're using that refund to pay down your credit cards at 19.99%. Then it is a big deal. Do your best to estimate your tax bill. And what are these two numbers? 90%, 100%. They may come in handy later on. You decide. But if you get a big tax refund, great. If you're using it for your maybe forced savings for a vacation because you get it in April or May or something like that. But if you're using it to pay down debt, no. Reduce the amount of money that's coming out of your paycheck. Take that money, send it to your credit card company, and get that monkey off your back. And then we talked about the other payments, the earned income credit, the refundable tax care credit. We talked about the earned income credit a little bit in the previous presentation. That is the ability of you to keep working. The Congress wants you to keep working. We know you're not making money. You probably have children. And it's very difficult if you're single to have the earned income credit apply to you. But if you have children and you're not making a whole lot of money, you definitely want to go to the Vita people, go get TurboTax or one of the other tax programs, and see if you're applicable, if the earned income credit applies to you. So line 33. We're finally done. Line 33 tells us how much money we've paid into the system, whether through our our W-2 through our employment or through some tax credits. And now we know how much we've paid in, how much we owe. In this case, he overpaid $121 and he wants it back. Don't leave the second one blank because then they'll think, oh, we'll keep it until next year. No, no, no. I want it now. And of course, if you see, it says if you don't put it here, you're supposed to put it there, and they'll apply it to your next year. And then if you owe the money, that goes here. We talked about the estimated tax penalty. If you did not pay the money throughout the year, or if you didn't pay enough and you owe a lot, they can hit you with a penalty. And so when this happens, you can write a letter. I've helped people do this. I'm sorry, I didn't take enough money out of my taxes. Can I not pay the estimated tax penalty? And every single person I've helped do that, the IRS hasn't sent them a letter saying, no, we're not going to allow it. In fact, one person did it twice. And I said, you have to have more money taken out of your paycheck. He comes back next year. I help him with his taxes, and he had still never went to the human resources and had more money taken out of his paycheck. So he said, what should we do? I said, let's write another letter. Oh, now I'm really sorry. I did it twice. And then finally, the IRS let it go. And then finally the next year he did do it, thankfully. And then don't forget to sign your, we talked about that. Make sure you sign your return and then date it. And then they want to know your occupation. And of course, A. King Back is a mattress tester. Of course, right? And why do they want to know your occupation? Because obviously, if you say you're a lawyer or a doctor and you're only making a few $1,000s a year, they want to know what's going on. We had one student who came to me and said, well, I was arrested for selling marijuana. And usually when they go after drug dealers, they go after the taxes because they didn't report their taxes. He reported all his income. He filled out his 1040 form. He was a business. And what did he put down for his occupation? Gardener, right? Cut flowers. He put down cut flowers gardener. Well, he wasn't lying, so they couldn't get him for tax evasion. They got him he had to spend 8 months in the state prison, not the federal prison. Very colorful character who took our classes many years ago. He passed away, though. He's long gone now, sad. So, folks, what do you think? Was it really that difficult? You're nodding your head. Yeah, it was. It was difficult. My apologies. It's tedious, but once you slog through them, it usually people go, oh yeah, I kind of understand it, until you want to hit one of the situations that we talked about. Stay away from this, or go take a class, or go talk to a professional. So how to avoid common filing errors. Check your arithmetic twice. Again, the IRS tells us that the vast majority of mistakes are just people adding when they should have subtracting, or they should have subtracted, and vice versa. Attach the necessary documentation. Put your social security number, the tax year, the form number on the check. Make the check payable to the United States Treasury, not the IRS. Keep photocopies. Put the proper postage. Better yet, file electronically. Careful. There are some systems that allow you to file electronically for free. And the IRS and the state of California are not only state, other states too, are saying, look, we're very happy that TurboTax and the other tax programs are making a ton of money, but we want people to be able to file for free. So TurboTax got in a lot of trouble with the feds because they said, oh yeah, we're going to make it free, but then they hid it. they hid the ability to do it from individuals. So I think they got fined or something, or who knows what happened. But check everything again, and if you need more time, file an extension. And this is what yours truly always does. I never have time in April because of school. I wait until the summer to do my taxes, and I file an extension. And the IRS doesn't seem to care. As long as you give them their money, and we always give them more money than we need. We always make sure we give them more money than needed. And so they never seem to bother because we file the extension. Uh-oh. If you find you made a mistake, should you leave the country, commit suicide, pretend it didn't happen. This is what a lot of people do. Don't do this. If you find the mistake, because sometimes they miss it, but the IRS is very slow. There's a lot of reasons for this, and they're going to get beefed up. They've been starved by the Congress, and specifically the previous administration kind of just did their best to destroy them. But now they're going to be beefed up, and they're going to have more resources. They'll eventually get to you, folks. It might take them 12 months or 16 months before you get that letter in the mail, official business only, that says you goofed. So if you do it, if you find the mistake first, file 1040X. And it basically says, here, I goofed. And you might wind up, getting money back. It might not be that you just have to pay. You might get money back. File 1040X. That's the correct answer. And lastly, don't forget the state of California. Once the federal 1040 form is finished, you get to tackle the state of California's Form 540. Fortunately, it is far less than half the work. It's usually just two forms, the 540, cute, huh? 1040, 540, and then the 540CA for California adjustments. Oh, my apologies. I know this is a slog, but go through it again. Do the first text exercise, follow it, then do the second text exercise. There's an answer key, then do the assignment. You can do it. Of course, if you have problems, if you have run into problems, you contact me. I'm more than happy to help you. And yes, no one ever said taxes were easy. They're tedious, but they're not that difficult once you apply yourself. In our last presentation, we'll take a look at some information sources for taxes and some tax strategies, and finish up everyone's favorite subject to hate, taxes.